Well, another week behind us. Big moves in yields. This row right here represents the change in yields week over week. Go out from the 1 year all the way to the end of the 10-year. Look at some of these moves in 1 week. So since the beginning of the year, these are the moves in yields, and this row here is where we currently are now. Have a look at the 10-year at 248. You got a 3-year that's above it, a 5-year that's above it, a 7-year that's above it. We do have one inversion from the 5s to the 10s, very small inversion. However, we are moving towards a flatter curve and potentially an inverted yield curve. And I have been asked, what's the big deal about an inverted yield curve? If you didn't know anything about yields and the shape of the curve, how would you know as a consumer that a recession was coming? Like what causes the recession? It can't just be drawing a curve on a chart and saying, uh-oh, it's downward sloping, that's a problem. There must be some mechanism. And it has to do with the availability of credit. So I'm going to draw out an inverted yield curve. And let's say that the Fed has raised rates and we're sitting at 2%. Let's say we have a 2-year that's sitting at 3% and a 10-year down here, and then we'll go up to the 30-year. So you have a big inversion from the 2 to the 10. Banks borrow at this end of the curve and they lend at that end of the curve. So they borrow short and lend long. Well, there's not much motivation to borrow short and lend long. So you could say, well, the bank doesn't have to pay those rates. It can offer depositors this rate. You wouldn't get deposits. You wouldn't attract any funding from consumers, and that's how banks get the money to lend out. You go to a bank, you show up, you buy a 6-month term deposit or a 1-year CD or a 5-year CD, and you're going to shop around and get rates, so banks have to be competitive. So that's out of the question. You got to pay what short-term rates happen to be. And then you have to make loans. You can always say, well, just do this. Somebody wants a loan, say, no, this is the rate you're going to pay, so that you have a positive spread between where you borrow and where you lend. Well, you're not lending the government any money at that rate. This is where you lend the government money. So don't lend the government money, you say. Just make a whole bunch of loans. Just what's wrong with corporate loans? And that may sound like a reasonable thing to do, except a bank has to maintain a certain amount of equity based on what it's called its risk-weighted assets. So it adds up all its assets and it weights them. Anything cash or treasuries is going to be weighted at 0%, which means it doesn't really need any equity to back that up. Corporate loans will be at 100%. So if it has $100 billion outstanding in corporate loans over the quarter, it makes $100 billion in corporate loans to the economy. It's going to need, for common equity, a minimum of 4.5% or $4.5 billion in extra equity to back that up. It's going to need $6 billion in what's called Tier 1 capital to back up this $100 billion, and it's going to need $8 billion in total capital to back that up. These are called capital adequacy ratios. So if a bank is already booked up in terms of the amount of capital that it has, if it does create more corporate loans, it has to create more equity somewhere, and it doesn't really want to do that. So it's going to manage its risk-weighted assets. So if you have this inverted yield curve, there is a limit to how much you're going to borrow at this end to lend to governments at this end, because there is a limit to how much risk-weighted assets that you can have. So the inverted yield curve affects the credit availability in an economy, and if companies and corporations cannot borrow, they cannot invest. If they cannot invest, they cannot grow. That's where you get the potential for a recession. But you need more than 7 basis points from the 5 to the 10 to cause some grief. So we are moving in the wrong direction, though. On slope, we are flattening, and we should pay attention to that. And we should be very aware. The 2 to the 10 and the 2 to the 20 are big ones to watch. Right now, that's 44 basis points. This is 18 basis points. These are not inverted. They're still upward sloping. They're just moving in the wrong direction. And as they move more towards flatter, well, banks become less and less excited about lending, and as it starts to invert, they become even less excited about it, and eventually they get to the point where they're just not going to do it. They just don't have the capital adequacy enough to support more of those loans. So that is, I hope that answers the question. That's a very high-level view of why an inverted yield curve is not a good thing for an economy, is because banks function based on the shape of that yield curve. Banks make the most money when the yield curve is steep and upward sloping, because they borrow here and they lend there. So the interest margin is the difference between the two, is very, very steep. The more that interest margin is challenged, the less exciting it is for banks, which is probably no surprise why. Most analysts will say, on a going forward basis, financials are probably not where you want to be. Well, let's have a look at our break-even rates. For that, we're going to need our real yields. Notice real yields are all higher. We have one real yield that is now positive, which is on the 30-year. And as they go positive, they'll go positive from the long end backwards. Let's see what happens over the course of the week. Break-even rates, all of them are higher. So inflation expectations are becoming less anchored at the 2%, level. The 10-year up 9 basis points to 2.95. Not much movement on the 20 and the 30, but you had some movement on the 10-year. So that is going to be something that I think the Fed is concerned about. It wants to get those break-evens down because they represent expectations. They'd like to see them well grounded at 2%. So it's not too soon to start handicapping what we think is going to happen at the May 3rd, May 4th FOMC meeting. May 4th is the announcement. 0 basis point change. I put 0% on that altogether. I don't see that happening at all. We got a 25 or a 50, and right now I'm split between the two. As far as balance sheet reduction, if they go 25 basis points, I put a 75% probability that they'll start balance sheet reduction. I think they'll probably say that they're going to let MBS run off first before they let Treasury run off, if they're going to reduce the size of the balance sheet. They may, if they go 50, I have a very low probability on balance sheet reduction. And here I would seem to think that they probably would still let MBS run off, but reinvest that into treasuries until MBS is gone, and then they may start to think about reducing treasuries. But I don't see 50 basis points and balance sheet reduction all happening at the same time, because the move on balance sheet reduction will change yields, which is a form of monetary tightening on its own at the longer end of the curve. So I'm not sure that they're going to want to do that. I think they're going to want to try to keep treasuries, especially the 10-year, low enough, and let MBS run off, because mortgages are pegged to the 10-year. You don't want the 10-year going too far. So I think while they're raising rates, I think they do have some work to do at the 10-year. So if they continue buying the 10-year with the MBS rolling off, I think they'll do that for a while they raise the short end of the curve. So we're sitting somewhere between 25 and 50. I think MBS is going to be the first target for balance sheet runoff. Are they going to let it run off to reduce the size of the balance sheet, or are they going to let the MBS run off and reinvest it into treasuries and just maintain the size of the balance sheet? I don't really have a position on that. It depends on the rates, and as we get closer to the meeting, these probabilities will come into sharper focus, I think. As of right now, Goldman Sachs is saying you got 50 basis points for the next two meetings. So over the May and the July meeting, you're going to get 100 basis points. Powell said he would go 50 basis points at the next meeting, and when asked what would stop him from doing that, he said nothing, really. So it looks like 50 basis points is a valid discussion to have, which is why I put a 50-50. Citi got really aggressive. They said they see 4 moves of 50 basis points. The next 4 meetings will have 50 basis points, followed by 2 more of 25 basis points. So they're saying 250 more basis points based on where we are now. That's a full 100 basis points higher than the Fed is forecasting for the end of the year. Citi thinks they're going to have no choice but to do that. So we have some key data, and another data point is going to come into focus and be just as important coming up. Our PCE is important, and more important than the CPI. The CPI is the price level, the change in the price level. The PCE is the cost of living index, because it does make adjustments. It does substitute when some things get too expensive. It substitutes, so it better captures the cost of living. So what we want to do with the PCE and the jobs report that we're getting April 1st, whatever the PCE number is, we want to see that average hourly earnings are at least matching that, so that real spending can remain constant. But if we see the PCE coming in at, well, the expectation is 5.5. We see it coming in at 5.5. This will happen Wednesday. And then Friday, you have the jobs report. You see average hourly earnings coming in at 3.5 or 4.5. That means it's not keeping pace with the cost of living, so that real spending or real spending power, real purchasing power is decreasing. Well, that's not sustainable. You know, it can work for a while as you work down savings and maybe work on credit, but at some point, those things have to come into alignment. Next big one is going to be real GDP for Q1. We're not going to see that till April 28th. And real GDP takes out the effective inflation. It'll tell us if the economy is expanding or contracting. You can have an economy contract 1%. But if the price level rises 5%, nominal GDP will show growth. But you didn't really grow. If you're producing less stuff, you need less people to make that stuff. So if real GDP is negative, it means less stuff was sold. Nominal GDP is the combination of what stuff was sold at what price. Growth is measured just by real GDP. And that is how much stuff or how many services or how much services got delivered. This number has been coming down and has been coming down quite rapidly. I'm going to show you a couple of really good sites that you can look at for this. And if you're familiar with the concept of GDP now, which I think we saw in level 1 just very briefly, and I think you see it in level 3 in the economic section, level 3 being referred to under something called nowcasting. And GDP Now, which is something produced by the Atlanta Fed. So we'll go and have a look at that. They even have an app where you can track GDP Now, but it's nothing more than just a summation of what you find on the site. So I went through the app and I go, well, there's nothing more here. This is not that exciting to me. I think the only exciting thing of the app is you could set it up for a notification that whenever GDP Now changes, it will tell you that GDP Now has changed, and you don't have to keep checking back. But it's updated once a week anyway, so, you know, there it is. So, this on Wednesday is going to be big. The expectation is 5.5. We'll see if that comes in lower or higher. Lower would be a good thing. It would lower these kind of forecasts, 4 times 50 and 2 times 25. Yields would drop. Bond prices would rise. And my expectation if this happened is that stock markets would drop as well. And I'll explain that in a few screens. The jobs report on Friday. How many jobs were created? That's going to tell us something about the economy. More jobs created, GDP Now will actually increase. We'll look at average hourly earnings, and if it comes in too light, GDP Now would decrease, so that the increase in jobs may be offset by the underperformance of average hourly earnings. And, well, we're not going to really see that till April 28th. What GDP Now does, just before I move on, is over the course of the quarter, there's 1 month, 2 months, 3 months, and then 1 month after, over here, we'll get what GDP was over this period of time. Well, there are different reports during this period of time, and GDP is the consumer plus investment plus government spending plus the trade balance. Well, we get data on this all the time. So as data comes in, GDP Now updates based on how far off these numbers are. So if it'll look at investment saying, well, we have new home sales down, building permits are down, so this is going to be down. So it downgrades the forecast for GDP right then and there because this goes into the model. So as each data point comes out, it gives some information as to where GDP will be. So it is it's called GDP now because it's saying based on what we know now, this is our forecast for GDP. Okay, let's contrast a 1 month chart of SPY with TLT. TLT being a proxy for the bond market, near enough proxy for the bond market. So SPY from 415, this was 2 weeks ago, 415 up to 452. This is in 9 days, rallied 8.9%. 415 to 452 is 8.9 on the 415. TLT over that same period, 133.16 down to 129, dropped 3.12%. We'll start down here. Rates. We know the Fed has signaled another 150 basis points by year end, and some other forecasters are saying, oh, it's going to be more than that. We currently have negative real yields, and we have less well-anchored inflation expectations. So the combination here, you have a more hawkish, over the last week with all the Fed speak, we saw that it is much more hawkish than we thought it was a month ago. More hawkish, so you have more, this is an expected return on bonds. Notice it's negative. You're going to have a more negative expected return on bonds, so more outflows out of bonds. That's how prices drop, is, well, selling, right? Well, it goes into equities because where else are you going to go? Money has to go to work. Where else are you going to go? So if we move up to equities, up here, we got outflows goes into equities. Fairly decent hedge against inflation, a better hedge against inflation than fixed coupon treasuries, which are not a hedge against inflation. Our EPS on stocks are nominal, as are prices. They're not real, they're nominal. So if you have a multiple of 20 and you have rates or EPS climbing, nominal EPS, real EPS may not climb. In fact, real EPS may shrink, but nominal EPS will climb. We only pay attention to the nominal EPS. You can multiply that, a higher nominal EPS as a result of inflation, with even a lower multiple and still have support on the market. As far as the economy, employment is a positive. Jobs are being added. There are more job openings than there are people that are available. This Friday, we'll see some more data on that. Last week, we saw that initial jobless claims are the lowest they've been since 1968, but you got to take that with a grain of salt. The labor force was much smaller in 1968, so that the number we saw this week as a percentage of the labor force is super, super small. Well, people don't quit their jobs when they're worried about the economy. People quit their jobs. There's a lot of turnover when you have a great economy, because I know I can get another job soon or a better job. But when you start to get worried, when inflation starts to get high, when you start to be concerned about the health of the economy, when consumer confidence drops, you don't quit your jobs. And listen, it is near impossible to find people to do work these days. The size of the labor force has shrunk so much. You need people to come into the labor force. So, to have that many people or to have that few people file for initial unemployment claims, companies are not getting rid of people and people are not walking away. So that in itself is a good thing. And so far, the expectation for real GDP is still positive, which is also a good thing. Once that hits the zero mark or even turns negative, then we got a bit of a problem. So this rally here, almost everyone I've listened to, almost every analyst that's been looking at this market, almost every commentator was caught off guard by it. Where is this coming from? It's not justified by the level of the uncertainty that we have in the economy. Shouldn't we be cautious? There is still uncertainty about what kind of inflation do we have? Is it supply side? Is it demand side? Is it transient? Is it persistent? Will it go away? There's heightened uncertainty as to the path of rate hikes. Will we get 150 basis points? Will we get 200? Will we get 300? There is uncertainty associated with energy supply. There's uncertainty associated with food security and food supply. There's so much uncertainty. Shouldn't we be a little bit more cautious? Okay, maybe not sell off to 3,500, but maybe not rally to 6,000? Can we find something in between? Maybe go sideways for a while? Well, I call this a necessity rally as opposed to an intentional rally. I don't know so much that money ran into this market saying, oh my God, I got to be in equities right now. There's never been a better time to be in equities. I don't think that's what was going on. I think that you had an extremely hawkish Fed, and I think that the bond market said, whoa, that is way more than we anticipated. Let's get the hell out of here. Hey, you know what? Let's go with that rule of thumb. Equities are a good inflation hedge. So let's go find some equities that are a good inflation hedge, that have pricing power, and let's go into there because there is no alternative. Much like 2 years ago when the pandemic hit, and the Fed lowered rates and started loading up on the balance sheet, I made a series of videos saying, do not short this market. No matter how ridiculous you think the price is getting based on the economy, don't short it because the Fed is standing right behind it. It's going to squeeze money out of every other asset class. Well, not every other asset class, but it's going to squeeze money out of fixed income. Where's it going to go? There is no alternative. You got to go into risky assets. Well, the Fed, in essence, is squeezing money out of the bond market right now. It's not squeezing yield out, it's squeezing money out by pushing rates up and prices down. You can stay in bonds and say, look, I'm going to get a negative return. But as long as GDP, as long as real GDP is greater than zero, I think equities could probably protect me a lot better than fixed income can. Let me go into there. So I think a lot of this rally was because a lot of this selling. That the hawkishness of the Fed was not support for equities. The hawkishness of the Fed was a good reason to get out of fixed income, and where are you going to go? And I think that's what we have in the market here is a result of, look, where else am I going to go? I'm going to lose money over here for sure. Why? Rates are going up another 150 basis points. I'm already facing negative real yields anyway, so what does it matter if real EPS are negative? It's already negative over here, and this is moving in the wrong direction. Let me out. Here, at least I have some hope. Okay, let's go to a website here. This is called Mortgage News Daily. You see it right here, Mortgage News Daily. MortgageNewsDaily.com. There's also a MortgageNewsDaily.ca. I'm not sure if there is for other countries as well, but this is for the U.S. Right at the very top, look at the 30-year fixed rate, 4.95%, up 24 basis points on the day. Here's a nice quick graph of mortgage rates, the 30-year versus the 15-year. Here we are at this end of the curve. If you look at the last high point, the 30-year fixed was, I think, hit a peak of 499. Yeah, 499. And we're 495. This was back in, it says at the very bottom there, Monday, November 12th, 2018. And then rates came straight down, and now we're right up the side of the chart here. And the last reading on this, I think is because they update it every Thursday, was 4.74. But we know that we went up 0.24 on Friday, and we're at 4.95, just below this peak over here on the 30-year. It gives you the relationship of MBS versus Treasuries, MBS in price, so we can see price coming down, and Treasuries is yield going up. And around here, if you scroll down, there's a whole bunch of interesting stuff to read. Some things you might find interesting up here if you're into mortgage REITs. What's up with the massive snowball sell-off in MBS, which would have affected mortgage REITs, so you can there's a lot of good commentary here. There's some housing news, all about mortgages, right? Come down here, and a lot of interesting stuff that you can read. Mortgage rates are close to 5%. Fed's Williams can boost rates by 50 basis points if needed. We keep coming down here. Look at this, Q1 Gdp Forecasts, under 1%. Click on that. And you're going to get Q1 Gdp Forecasts and whose they are. Bank of America. Our first quarter GDP tracking estimate moved down to 1% quarter over quarter. That is the seasonally adjusted annual rate, that's SAAR, from 1.6 previously, reflecting weaker than expected housing and inventory data. Q4 2021 GDP, which I think we see this week, we see the final reading of it, is likely to get revised up modestly to 7.2 from 7 in the third and final revision next week, which is this coming week. They're saying that as of the 25th, so it's this coming week. But that's rear view mirror. I don't think it's going to matter much. This is down from 1.6 down to 1, just based on the data out over the last week from Goldman. Following today's data, we left our Q1 GDP tracking estimate unchanged on a rounded basis at 0.5% quarter over quarter. And from the Atlanta Fed, the GDP Now model estimate for real GDP growth in the first quarter of 2022 is 0.9% on March 24th, down from 1.3% on March 17th. After recent releases from the U.S. Census Bureau and the National Association of Realtors, the nowcast of first quarter real gross private domestic investment growth decreased from negative 4.2 to negative 5.8%. And you'll recall when I wrote out the formula for GDP, the high-level formula, C plus I plus G plus X minus M. I is the investment category, and there it is right there. Real gross private domestic investment, because of the drop in housing, the building permits, and new home sales. They're saying, well, you're going to have lower investment there from negative 4.2 to negative 5.8, which lowered their GDP from 1.3 to 0.9. Their forecast of what Q1 GDP is going to be based on what they already know. So we're going to have a look at GDP now at the Atlanta Fed shortly. So it's a nice little site to play around with. There's a lot of really good stuff on here, and I leave it to you. Okay, I've written the word stagflation at the top of the screen. You're going to hear more and more of that word. Are we headed for stagflation? And an easy definition of stagflation is you have elevated inflation above the upper target for a central bank, combined with negative real GDP. So from the site mortgagenewsdaily.com, we know GDP now, based on the Atlanta Fed is gone from 1.3 to 0.9. Bank of America is down to 1%. Goldman Sachs is up 0.5%. We saw in the last Fed meeting, the summary of economic projections, the Fed had decreased their forecast for real GDP for 2022 from 4% down to 2.8%, and had unemployment not changing while inflation was coming down, rates were going up. And if you review that and look at it, what they're saying is we're not going to have a hard landing. We're not even going to have a soft landing. We're going to have an absolutely perfect landing. You're not even going to know the wheels hit the tarmac. You're going to not even know we're out of the sky until the pilot says, "Thank you for flying with us. The doors are now open." You believe that? I don't. Anyways, we'll look at their website, and you can, if you have the app, you can look at the app as well. We'll look at it shortly for GDP Now. So let's break these both down, because we got to pay attention to inflation and where that's going, and you got to pay attention to real GDP and where that's going, because if this does occur, that is never good for anything. So inflation, well, you have supply and you have demand. We have two factors at play. And with supply, we do have bottlenecks, and because of energy, now we have shocks, two types of shocks, energy shocks and food shocks. The longer this thing goes on in Ukraine, the more it's going to affect food. And let's look at the last few years. It hasn't been that great for food either, with droughts here and floods there. So, just the climate alone, the changes in different climate patterns in different planting areas causes some grief, has been causing grief already. Combine that with, maybe some acreage that is simply not going to be planted this spring. Energy. you've had a number of issues with energy. You had that attack in Saudi Arabia from Yemen of storage facilities. But that's going to give some people some ideas, saying, hey, you know what, given the position in the world right now and where the world is, the best form of attack is on energy supplies right now. Let's blow up a pipeline. Let's attack some wells. Let's do these kind of things. Let's destroy a port. I'm not the only one that thought of that when I saw that happen. I thought, now's the perfect time to have that kind of energy terrorism or that kind of energy warfare. I don't know. I think there's not enough concern about energy there. On the demand side, employment is strong, which supports demand. Wages, you have had wage growth. That supports demand. So that is, increasing demand, which is the wrong way for inflation. However, you do have higher rates, which will lower demand, especially for durable goods, autos and homes. And we've already seen some data this past week with mortgage applications and new home sales. And of course, that's already feeding into these forecasts here and lending themselves to moving, the forecasts are moving closer on the real GDP, are moving closer to zero. Got to watch consumer confidence, because consumer confidence will affect non-discretionary spending. The more confident you feel in the economy, the more willing you are to go out and buy big ticket items or durable goods, because typically the average household would finance a portion of that. So non-discretionary spending gets affected, especially durable goods. And we saw this week on the March 24th, durable goods came in at negative 2.2% versus an estimate of negative 0.5%. Well, that's what consumer confidence will do. If you take out transportation, it's a cleaner number. Take out transportation, durable goods dropped 0.6% versus an estimate increase of 0.6%. So based on, the headline number and the ex-transportation number, durable goods came in much lower than expected, negative on both counts. So you had this happen. Mortgage applications on March 22nd came in negative 8.1%. New home sales came in at negative 2% because we are taking a hit to levels of consumer confidence. Coming up this week, on the 31st, on Wednesday, PCE, the forecast is for 5.5%. That's on core. And on Friday, we have the jobs report. Pay attention to average hourly earnings and compare it with this, whatever this core forecast is. And pay attention to the participation rate, because the participation rate will talk about supply. One of the bottlenecks we're having is participation. The participation rate is, you just can't find people. So if you can't find people, you have wage inflation. If you have wage inflation, it keeps pushing up on inflation at the same time. And higher wages, if wages go up 4%, but inflation is going up 5%, then real spending, real purchasing power decreases, which is going to be a negative for real GDP. So I think these two things we want to pay attention to. We want to make sure that this is equal to this so that real purchasing power is increasing. Love to see that participation rate really increase, because if it does, then it lowers wage pressure, which then would lower some inflation pressure at the same time. I'm absolutely certain these are the same things the Fed is going to be watching. It's important to know what we want to pay attention to so that we know when we want to change our mind about something or when we want to raise our probability of something else happening. And if you are, in the markets and placing bets, betting the probabilities is always the safest place to be. Bet in the favor of probabilities, whichever way they're leaning. Let's have a look at GDP now. Okay, all of these links are available in the description box, and this is the site for GDP Now. There's a lot of stuff on the side that will tell you exactly how it's calculated. Here's the GDP Now model data and historical forecasts, the dates of releases of when they release new data. It's every Thursday, and you can read through this, but we'll go down to the chart down here. Last estimate 0.9% was March 24th. You click over here, you can get the app. I mean, if you're going to visit the site, the app doesn't have that much more other than the notification, but it's updated every Thursday anyways, right? So the GDP Now model estimate for real GDP growth in the first quarter is 0.9 on March 21st, down from 1.3 on March 17th. We've already read that. The next GDP Now update is Thursday, March 31st. Please see the release dates tab for a list of upcoming releases. And they compare it with analyst forecasts as well. This is the range. It's a range top 10, top bottom. And they take the middle of the range. You can see that those forecasts have been coming down. And here is the Atlanta Fed GDP Now based on data that is coming out. So you can see, it was, close to 2%, and then it turned negative and played around with the negative line before coming back up. And notice this drop down here, and you see later on that the analysts' forecasts start to turn down as well. So, it is capturing something. I think what's more important is the general direction of GDP Now as opposed to the precision of it. So I would, tend to look at it more that way, and it's starting to turn back down again. So this line here, the zero line, is the one you really want to pay attention to. And here's model description. You can click on it. It describes exactly how it calculates GDP Now. So if you're interested in diving a little bit deeper on that, if you're more technical and you want to see how the model is described, so you can determine what weight you want to put on this data. Whether okay, well, I'll read it, but I'm not invested in it. Or if you think, well, yeah, that makes a lot of sense. That's up to you. I think you can get it from here too. A model for GDP nowcasting. We came across the term nowcasting in level 3, and GDP Now is an example of nowcasting. Okay, here is the S&P 500 over the last year. Here's our last 2 weeks of performance right up to there. What I'm calling a necessity rally. Or a lack of alternative rally as opposed to an intentional rally. At this level, we are trading at 19.76 times forward earnings. I'll show you where I'm getting the forward earnings here. We're at 225.47. This is from the S&P Global.com site. As of the 24th, energy EPS have been upgraded, but earnings in other sectors have been brought down. So we end up at 225.47. Interestingly enough, if you remove energy from the forecasts, right now we're expected to show something like 3 to 4% growth quarter over quarter for earnings. This is for the full year, by the way. The quarter's like $51 in earnings. We'll have a look at the spreadsheet that I downloaded from here shortly. If you remove energy, it's actually negative 1% growth quarter over quarter. So energy is saving the level of the index here. Here's 20 times, here's 18 times. And as I said, EPS is nominal, not real. So if inflation is going to show up on revenues and expenses, and you can maintain margins, your EPSs will increase by the same percentage. So you could have a good move up in EPS even with a lower multiple, and still justify the levels that you're at. I don't know. I'm not sold on that. If you look at the producer price index versus the consumer price index, the PPI is much higher than the CPI, so you have less than 100% flow through. I know that. And if energy is the only one saving the day, sure, you might have energy earnings at the cost of earnings that are more sustainable for an economy. Energy making that much money is simply not sustainable because it is demand destruction. I'm not buying in to the intentionality of this rally. As I said, I think it's more of a lack of alternative rally. And as bond prices drop, stock prices have risen. Well, there's going to be a point where, you're going to start to go sideways, and I think you're going to start to go sideways here. And if the data for inflation comes in a little bit lighter, if the economy starts looking a little bit stronger, such that the Fed is not going to raise rates as much as they thought they would, you're going to get a rally in the bond market. And I think you're going to get some of that money that went into the stock market due to lack of alternative maybe come out. I'm still not sold on this rally because uncertainty has only increased. Now, here's the thing, the unsettling thing about uncertainty and risk. If you look at January versus March, and I ask you to list risk premiums, you're going to have higher risk premiums in March. I can't see that you would say there's less risk in March. Based on what I know, there's less risk today than there was in January. Risk premiums are going to be higher. However, it is not so much the existence of these higher risk premiums that we need to pay attention to, but the length of time at which these risk premiums have been with us. Because risk has a way of doing this. Let's say that we have perceived risk of this. Let's say, and this is time, and this is the level of risk that we see, and we had maybe a level of perceived risk like this, and then suddenly events happen, our risk perception increased. And the event that we thought was going to happen does happen. Here's what happens to risk over time, is it comes right back down. Even if the risk factor itself does not disappear, even if the event, which would have been negative, actually happens, the longer we live with it, the less salient it becomes. It goes into background noise. What I said last week, the longer, and I said it the week before too, the longer something goes on, the more it simply just becomes part of the background and we just ignore it. At whether you want to call that a benefit or an advantage or a disadvantage, I don't know, but none of these risk factors, again, if I say January versus March, are risk premiums higher, you would say yes, risk premiums are higher. If risk premiums are higher, shouldn't there be more caution? Do we really think that we're going off and printing new highs only because, well, listen, there's more risk now and risk premiums are higher than they were 3 months ago, so let's go higher. That's why I think that this has more to do with the sell-off in bonds and the hawkishness of the Fed and that money having to go somewhere. And you may as well say, look, old rule of thumb, equities are a pretty good hedge against inflation, so let's find those equities that are a good hedge against inflation. They tend to be concentrated in the large cap space, so let's move over there. So as far as levels go, I was when the index got to 43, I was selling calls. I was selling 440 and 445 calls, and I haven't removed those calls. I'm still fairly convicted on it. However, I am risk managing that position, and I am very data dependent right now. I'm very interested to see how we open on Sunday night on Globex, given that some energy assets were targeted. They were storage facilities. I mean, not a big deal, but still energy assets were targeted. The side that wants to cause trouble knows exactly what assets they want to hit. They want to hit energy assets. Is that going to be the end of it? Or is somebody going to say, hey, that's not a bad idea. We can hurt a lot of people very, very quickly by targeting this infrastructure or targeting that pipeline. I'm not really sure. So, being data dependent at this point, earnings, really, I'm not going to see much until April. We're coming into the last week of April right now. I got jobs data in front of me. I got PCE in front of me. I'm going to watch that, and I'm going to watch the tape. Watching the tape means you watch the tone of the market. How does it feel? How does the bid feel? Watch the S&P. Is it, when it pulls back 2-3 points, is it well bid? Does it find good support? If it does, sometimes going along with the flow can help reduce any pain you're feeling that day on anything. And I watch my delta, my combined delta. So if somebody says, what position do you have? I don't list a whole bunch. I know exactly what my delta is. So I'll show you how I do that. Right now, let's go have a look at this spreadsheet for S&P Global. And you'll see that there's a whole bunch of great stuff that you can play with there. Okay, here it is when you first open it up. This is what you'll see. And you have some tabs along the bottom, estimates, NPE, sector EPS, quarterly data. Let's go over to sector EPS. And here's the index name. We have the S&P 500 and the sectors of the S&P 500, the current price of the S&P and the price of the sectors as well. So if we scroll across, these are all 2016, 2000. You have a lot of data, historical data going all the way back to, this is Q1 2008 for the S&P. So you just can follow it along until you get to the estimates. And I've highlighted 2022 for you, Q1, Q2, Q3, Q4. So Q1 is 51, 24, 55, 58, and 60.07. If you add them all up, you get to that 225 that we got to. This is the 500, this is the 400, I think, the 600. If you scroll down, this is actual results. We're not going to actually have those until they start coming in April, but this spreadsheet is updated regularly. So we have this 51.24. We just have to watch this cell here and see, does it come in at 51.24, higher or lower? And then we can determine which sectors we want to pay attention to. We can decide that we want to eliminate energy altogether. Let's just take energy out and see what happens to earnings. Same with up here, 51.24. You can take energy out. Energy is, let's see, across there, so I'll highlight that. So energy is 1264. So if you take 51.24 minus the 1264, that's what earnings would be expected to come in at for the other sectors altogether. So you can see exactly what it does come in at, because I don't know that getting all your earnings from energy is going to be sustainable. Keep scrolling across here. Here is the 2022 EPS and the 2022 PE based on our current price now. We're at 19.76 forward earnings. This is the EPS for 2022 for every sector. And again, you have energy at 52.90. So over the course of the year, you can see where the earnings, or at least where the expectation of earnings would be. And if you scroll down here, once we actually get those numbers, they'll start to fill in this area here for the S&P 500. And then you have a whole bunch of other different tabs as well. You have beats and shares, and this is really small. If you want to read it, you can make it bigger, and it tells you for the quarter how many reported. Energy 21 reported, 15 beats, 6 missed, 0 met. It gives you the percentages of what you're looking at. Lots of good information in here, and then you have historical data as well, all the way back to 2013 in terms of how many beat, how many miss. There are your percentages here as well. So there's a lot that you can play with in this spreadsheet. Link, again, is in the description box. All right, on this screen, I'm going to give you some idea of how I manage a position. And what I've got open is a number of calls, but we'll just look at this in terms of one call. But I've got some 440 calls that were sold at 614. These are April 440 calls. And I also have some May 445 calls that I sold at 1364, with the index sitting, the ETF sitting very close to 453. I am underwater basically on the April 440s because my break even is 446. We're at 453. And at 1364, the current price of the call puts me negative on that one. So what I've done is I add to my position. When my delta on this call got to negative 0.64, that's when I said, I'd like to cut that in half. So I simply just added 32 delta by buying 32 shares of the underlying per contract, and I bought that at 448. So that took my delta my current delta from 0.72. This doesn't change. This 32 stays at 32 because it's only 32 shares. Each share has a delta of 1. So per contract, it's 0.32 delta. So I have negative delta of 0.4. Now somebody may say, well, why not just get out? If I get out now, the call is $17. 440 to 453 is 13, which means I'll lose $400 just in time value. I can hedge that out. I can work that position to cover off that 400, which is the same as making $400. If you're willing to take a $400 loss, or if you can hedge your position out over time to save that $400 loss, it's the same as closing out, taking the loss, going somewhere and making 400. So it is the same as making that kind of money. If the index finishes at 453 at expiration, here's the situation. I lose 686 on the call, but I offset it with 160 on the underlying because I have 32 shares. That would be a $5 move. So I lose 526, and if I let them expire, I would end up with a short position of 68 SPY, which would give me 68 delta, which I would then add to the May position. So this would be another 68, negative 68 delta on this. The May 445 call, I got 1364. I'm just, $5 under break even there. Negative delta on that one. And I wanted to move that delta closer to 0, so I bought I shorted. I shouldn't say I added. I said plus. I added a May short put, negative 445 on the put. Sorry, negative P at 445, negative put. Got 1326, so my total premiums are 27. So my break even is nice and wide, 418 to 472. And that gave me 39 delta on the negative 60. So this position is very small in terms of delta, negative 0.216. I have my risk navigator up pretty much all the time, and I'll have one row that has a plus sign with SPY. If I click on plus, it'll tell me all my all the securities I have related to this. What I do is I just look across and I look at what my SPX index delta is for my whole SPY position. Is these two numbers right here. You add them together and that is my delta. If I feel that, you know what, the market is going to move against me, I don't think about which position I want to manage. I don't worry about that. I just look at that delta and I say I've got negative 616 delta per contract. Maybe take that down 20%. So I know if I'm going to take it down 20%, I'm looking for 14 delta somewhere. The easiest way to get 14 delta is to buy 14 shares. Somebody may say, well, why don't you just buy 100 shares? Because the call is for 100 shares. Why don't you just buy 100? If you would have bought 100 at 448, this is 614, you'd only lose 186. Yeah, but what if I'm wrong? What if the market turns against me? By buying 100 shares, I'm making a different bet altogether, because if I buy 100 shares, I'll add 100 delta on this 72. I now have positive delta. Is that what I want? Do I want positive delta? And what if I'm wrong? Well, now this positive delta is going to hurt me on the way down. Pain on the way up and pain on the way down. I don't want to do that. I just want to manage that delta. I just want to make it less painful on the way up. I know what I'm doing, right? Look what happens if I bought the shares and I shouldn't have because the stock fell. If it ends at 440, let's say it goes back down to 440. I bought these at 448. Well, I make the full 614 on the call because I sold the call for $6.14. I'd only lose 256 on the 32 shares. 8 times 32, 256. I still make 358. So what I've done is I put myself in a position where I'm going to lose less now on the way up because I have managed my delta downwards. However, if I am right, if my initial position was right to begin with, I'm still going to walk away with a profit. My break even is all the way down at 428.81 based on these shares. So hedging out, just looking at your delta position, rather than saying buy, sell, buy, sell, buy, sell, look at your delta position, say, well, I'm going to manage my delta. And if the market is moving against me and I have negative delta, I want to move that closer to 0. That's all I'm really trying to do, is move it closer to 0. If I'm moving it into positive territory, well, then I'm making another bet altogether. I'm making a bet that we're going to continue to move up. So let's have a look down here. As of right now, a 453 put is 812. A 444 put is 532. If we end at 453, I'd lose 526. And if I think, well, maybe this is where we're going to end, and instead of losing 526, I could just sell a 444 put. That would give me 532. The combination of earning this premium plus earning all the income on the SPY would more than offset the loss I get on the call. It's just another way that I can think of, hedging that position. The pushback that you sometimes get is, that's a lot of work. Why not just close your position, take your loss, and move on? Working from a loss position towards zero is the same as working from a position from zero to a positive gain. These are sunk costs. That's already done. The damage is done. These are sunk costs. And in level 1 and level 2 corporate finance, when we look at capital budgeting and looking at investing in projects, what is the one thing that we ignore? Sunk costs. Sunk costs mean nothing for decisions going forward, so you ignore these sunk costs. And I'm going to have a plan. What's my plan? It's not as if I'm just going to wait and see what happens and respond. I have a plan of action. If the underlying increases, let's say SPY continues to increase, I'm going to want to get this closer to zero. I'm going to sell a put to get that done. I'm not going to buy the underlying. I'm going to sell a put to get that done because I don't want to buy the underlying on the way up. I'm going to buy sell a put to get that done. And let's say that my delta gets to negative 0.7. I don't want it at 0.7. I can determine how much of that I want to get rid of. I might look at that and say, well, let's get that back to 0.45, negative 0.45, which means I know I'm selling a 25 delta put per contract that I have. So if I have 10 contracts out, then I size it by the number of contracts that I have out. But my goal is to move it closer towards zero. As I move closer towards zero, it doesn't require more margin because I'm getting more and more towards a neutral position. If you sell a call and then you sell a put, you don't need more margin. The reason is the stock cannot both be up and down at the same time. Only one of those things are going to hurt you, and that's where you're going to need your margin. It cannot both go up and down at the same time. So it's not as if I'm continually increasing my capital requirements. If SPY goes down, I'll add more to my underlying position. Now, if SPY goes down, my delta will change as well, and I'll determine at that point, well, is this just a pullback for the day? Or has the market finally caught on that, no, this rally was one of necessity, not one of opportunity, and selling comes into this market, or there's more negative news or something bad happens. Again, you got to pay attention to the tape. You got to read the market. What's the data coming in? And you have to be willing to change your probabilities and willing to sell different parts of your return distribution to manage your risk. Risk is not a set once and forget it thing. It's something you manage over time. So if SPY drops, I'm not going to sell puts. I'm just going to add the SPY. If I do sell puts, it's going to be a deeper out of the money put than the 444. Or I may look to offload a few of the calls that I've sold and close out some of the long position in SPY. If I can close them off and neutralize them, I may do that. I don't know. If I do have the shares put to me, let's say that nothing much happens, this thing goes sideways, and theta takes care of the other $4. Basically, I save $400 by not closing them out. If I do get this kind of situation here, on the day that these would close out, I'd probably be more apt to roll the call forward as opposed to have this position. I'd probably roll the call forward and add it to the May contract, and my delta here would change by that much, and then I'd manage that position when that happens. And this is, look, nobody in the history of this game has a 100% record, and what is even more difficult is to be right in time. it's not that hard to be right. You can be right more than 50% of the time. If you have experience in education, you can be right more than 50% of the time. But if you're trying to be right and be right in time, brutally difficult to do. So take time out of the picture. All things can happen to a position while you're holding it. It can go up, can go down. Just because you have a position doesn't mean the market's going to agree. What you want is a trading plan. And a trading plan that is, I'm going to buy something at X dollars. If it falls back 2%, I'm going to have a stop loss. And if it goes up 8%, I'm going to have a take profit. That's not a plan. That's a game of checkers, because you're playing one move ahead. If you tried to play chess one move ahead, you will lose every single game you have. You have to play multiple moves ahead. This happens. Am I okay? Yeah, I don't mind being long 32 shares per contract at this point. I don't mind being long the market, because if you have a 5 or a 10-year horizon, who cares? Who cares? And if I have enough shares that I'm long, I can then sell calls against it. If I really don't want them, I can sell calls against it and roll it into cover call positions. There's a lot that I can do. So I try to design my trades in such a way that I'm really managing just the delta of one thing. I'm not trying to juggle all these positions and say, well, what do I do with this position? What do I do with that? Just look at your overall delta for everything and try to design positions in such a way that no matter what happens, you're okay with it. And what keeps you in the game is a very simple thing: size. Don't let one position get so big as a percentage of your portfolio that it hurts you every time it moves against you. It has to be just one of those little things that move against you. It's like, oh, okay, well, it's moving against me, but I can manage that out. Manage the size. That is upfront risk management. If you have the size, you can stay in the trade longer. And the longer you can stay in the trade, the more opportunity you have for it to work. All right, let's update some trades here. A couple of weeks ago, I put out on my weekly update my puzzle with the Canadian dollar of why the Canadian dollar was not stronger. That was 2 weeks ago. For those of you on YouTube who don't have access, who did not have access at the time to my site, you wouldn't have had that weekly update. You only had the last one from last week where I did show the Canadian moving, and the Canadian moved again. So from the time I had put out my big question of what the hell is going on with the Canadian, it then moved 145 pips, and then it moved another 128 pips. So this is working. The question is, what should I do now? Because you have to have a plan for your trade. Should I stay in the trade? And the answer, to answer that question, you would ask yourself, would you enter that trade now? Given where the price is at 124.76, would you at that point say, you know what, I think the Canadian dollar is really attractive at this point? And if you can come to the conclusion that it's attractive, you would stay in the trade. So the Canadian dollar does respond to oil prices, and the more salient oil prices become, the higher they go, the more the Canadian dollar gets more and more attraction. This is the last price on the different blends of oil that Canada has, and if we just look at the last price, you say, "Oh my God, it sold off." It's down, on that day. But back at March 11th, these were the prices 2 weeks ago. 101, it's now 108. This blend was 103, now 109. 101 is now 107. 107 is now 113. 104 is 110. 109 is 115. They're all higher. They're all $6, $7 higher per barrel. So if these prices here in this column were enough to get the ball rolling on the Canadian down this hill, then these prices here are enough to keep it going. So I'm good enough with that. And in Europe, with the summit these past few days, our country stated that it will do its share and export as much more oil as it possibly can. That's only a positive, because new money is coming to the country that never existed before. That is really just a positive. And our central bank is just as hawkish as the U.S. central bank. Our central banker said before the U.S. central banker said, I'm willing to go 50 basis points. Said that way back. So that's why, said it way back here. That's why I'm wondering, well, why are we doing this? What's going on here? And then we finally had that break. So I'm going to stay in the game. I did lighten up. As it moves, I say, well, let's lighten up a little bit. Not a lot, 5% here, 5% there of your position, but, keeping the majority of it. But I think I'm going to continue to be long the Canadian against the U.S. dollar for now. I do see more strength in the Canadian dollar ahead. Finally, TLT. Back in December 13th, I had put a video up on YouTube for the market outlook for the year ahead, and I suggested selling the January 23rd 135 calls. They were 1860 at that time, and each call was going to require 45.50 in margin, and I put this trade on myself. March 25th, these calls close at 645. From 1860 down to 645. The current stats on this delta is 0.438. If you're short the call, you have negative delta here. 0.438. Theta is really low, 0.018, because these don't expire till January and there's not that much premium in here. So if you close the calls out now, you earn $12.15. That's the difference between these two prices on your initial margin of 45.50. It's 26.7% return. And your margin wouldn't have decreased because you had sold in the money call, so it would have stayed at 45.50, 26.7, but it's only been 102 days. So if you multiply it by 365 over 102, you get a 95.5% annualized return on that one. TLT worked out a lot faster than I thought it would. And that just seems to be the tone of U.S. markets, is if there's a one-year forecast, there seems to be a collective thought of, well, if the price is going to be there in 1 year, what are we waiting for? Let's get there now. And off you go. It used to be that you could build a position over time. Not anymore. If you have a conviction about something, you pretty much got to put a full position on now, because the market just says, well, if we're going to get there anyways, let's just get it over with and get there now. And off you go. So anyways, anybody who had this trade on, it's your call. I find that it's the risk reward at this point's not really worth it, because it's 645 on the same margin requirement, and you do risk inflation improving through base effects. And if inflation improves through base effects, it's going to do a lot of work for the Fed. The Fed may become less hawkish than what it really is, and you could get a rally in bonds. Being that we are here, why squeeze out the rest? So at this point, I think I would be more apt to close these out. And then on any rally upwards, I would probably start thinking about, levels, what kind of levels that I would be willing to sell calls against on this one if I wanted to re-enter at another price. And that will take me through this one for this week. And again, there's a lot I could talk about. You can go on for hours and hours about all the different sectors, the different companies, the different interesting things to look at. But I like to give a high-level view, give one or two things. And, what's more important, I think, is what do we want to keep our eye on? And this week is Wednesday. Watch that PCE number. Watch where it comes in relative to expectations. Watch the reaction in the market. That gives you some information. Watch the reaction in bonds. That's going to give you some information as to where the money is flowing. It gives you some idea of what's going on. And then, of course, if you're worried about GDP growth, then the jobs report on Friday is definitely something you want to keep your eyes on. What we don't want to see on Friday is a low number and low wages, or a low increase in wages below the PCE number. Because if it's below the PCE number, then real purchasing power is decreasing. That's not positive for real GDP. So, there it is.